I would like to introduce this session that our speaker is Rahul Ranjan da, and he is the topic of his presentation will be on the guide to personal wealth management since he is working in the finance sector, and I think we will gain a lot of knowledge in the personal finance with this Adda session. And Alok Pridashida from his batch will be introducing him. So I will hand over the session to Alok da to introduce Rahul Ranjan, and maybe later on Rahul da can continue. So Alok da, over to you.
Yeah. Before we start this chat, I think Rahul, we are from the same batch, which is candidates 92 batch, and we have been, we have done our schooling together. Meaning after 12th, in 12th also we were in the same school. Then we also did our MBA together from IIM Kozhikode. Of course, there was 1 year overlap. Rahul is technically 1 year senior to me in an MBA. So and he has been in this space of investments as a fund manager in different companies, and he is, I think, the best person to probably speak on this topic because he has been in this at various positions and now at a pretty senior level in Bajaj Finance. So I think I will hand it over to you, Rahul. Before that, I mean, this topic is something which interests everyone, and it should interest everyone. I mean, we as a kid we said that health is a state of physical, mental, emotional well-being. Probably in Vidyapit we added one more. We used to tell it's spiritual well-being as well. So and probably we should add financial well-being to that, and which is also important. Not that it's very important and the most important thing, but really, in the overall scheme of things, it's important because it's something which without which it's very difficult to be happy. And of course, with a caveat that it doesn't buy happiness, but yeah, it's very important tool to achieve a lot of things that you have in mind. You have your life goals. To achieve that, it's good to be a good wealth manager, and everybody is a wealth manager on their own. And there are very basic rules to it. Probably Rahul will start the whole discussion trying to give you a sense of each area where you need to know. We need to learn about what are the avenues of financing, how much to finance, when to invest, and what are the risks associated with it. So those things after that, and I mean, then probably Rahul will then summarize the whole thing in terms of a few thumb rules which we need to know, we need to learn, and we need to remember. And to make it simple, it will be a few thumb rules which will ensure that everybody who is watching this podcast or Praktani Adda will benefit immensely. So over to you, Rahul.
Yeah, thank you, Alok, and thank you, Praktani, for inviting me and Alok for this session. So as Alok told, we come long way together. We did our schooling from 10th together, 12th together, and MBA together. And just to introduce Alok, Alok is a vice president at Reliance Industries. He has been treasurer for Reliance Petrochemical for a long period of time. Now he is managing different kind of aspect for Reliance Finance. So completely Reliance being the largest company of the country. So he has handled very complexity regarding finance from the forex product to the currency product. So and all the petrochemical products. So I will need help of Alok in explaining some of the terms that we will be using. So let's start the session. The session is about a guide to personal wealth management. As Alok told, it is really important to manage wealth, whatever stage you are in the life. And because we want to live happily, we want to live happily for longer period of time. And even if we are not around, we want to leave our family happily. So these three aspects we will cover, and then we'll move ahead. So yeah, so the agenda is we will start with risk. And then we will move to the investment choices, asset classes, portfolio constructions, key points, and then finally Alok will take the career options in finance very briefly, because that would be useful for the younger brothers that who are still exploring what to do in career. So understanding risk is very important, because we tend to copy others in terms of financial management, but that might not be the right way to do it. So be aware of taking financial cues from people playing a different game than you are. This is a very important line. So the idea is to arrive at a risk profile and then decide that what kind of financial journey you would undertake. So this is an interesting picture in which there are very animals around, and the giraffe is inside the water, and it is telling that, guys, come on, this is not very deep. But the others might think that he's saying the truth, but the truth is that everybody is different, and everybody risk profile is different. Everybody requirement is very different. So risk is very different from each other, and we have to understand that what kind of risk we take in life and what kind of aim we have based on our risk profile. So let's define risk for us. What is risk? So one of the easiest definition is risk is volatility. And it can be because we don't have a better definition of risk. So we come with this definition that risk is volatility, but it might not be true in all circumstances. So there is no recipe for formula or for investing or dealing with risk. Every one of us has a unique tolerance for risk, and we are more or less comfortable with various factors that we create it. Some people have their own thumb rule that what kind of risk they can undertake and what kind of risk they can avoid. So remember, there is always a positive correlation between risk and return, but that would hold true only in the efficient market, which is very rare globally. So all the theory that we discuss here, all the theory that we get to read in financial newspapers, they hold value only in the efficient market. And remember, the efficient markets are very rare. So let's try to find out what is risk. How can we have a risk profiling? So financial risk will have two parts. One is risk capacity, one is risk attitude. So risk capacity defines that ability to take risk. Risk attitude is willingness to take risk. So any person who wants to build a financial wealth has to first analyze that what is his ability to take risk, at what stage of life he is, at what stage of financial journey he is, and whether his attitude, whether his whole persona is ready to take any kind of risk. So otherwise, he will just muddle through all the options, and then he will reach something which is not suitable to his risk profile. So there are some common ways to assess risk. One is heuristic based, that will lower the age and higher the risk taking ability. Then we have a goal-based risk, in which we just decide some kind of time period, some kind of uh, milestones in life, and then we decide about the profile that we undertake. And then we have tool-based questionnaire, which is a professional kind of way which any financial advisor can guide you. So based on that, we have divided the whole profile in 5 segments. That there can be the people can be divided into 5 segments. One is a person can be completely risk-averse, and then he can be conservative, he can be balanced, he can be growth, and he can be aggressive. But please note that most of us would fall into first two. Some of us will fall into balanced, who is really more financial literate. But it is very difficult to get into growth and aggressive kind of risk profile, because they require some kind of professional competence and professional guidance to reach at those kind of level. But once you understand that what kind of risk profile we have, then we can easily find that what kind of financial journey we will have. So let's look at the risk. Why we call it risk averse? Risk averse is completely into debt. That means you are completely into, say, a fixed deposit kind of instrument, and you don't take any exposure to equity or alternate. By alternate, we mean here real estate. By alternate, we mean here gold. By alternate, we mean here private equity. By alternate, we mean paintings, the land, something like that, which is not part of a financial instrument like debt or equity. So when you look at the conservative and balanced, it is kind of 50-50, 80-20. So this is the profile we are looking at. I would not advise to go to growth or aggressive without a proper guidance from a financial advisor or financial competent people. So most of us would bank on conservative and balanced. That means around 80-20 or 50-40. So let's look at the next investment option that we'll have to reach such kind of investment journey. So first, we are looking at the equity asset class. So what are my options in equity asset class? So direct equity means you go and buy shares of different companies, and we think that we are smart, we can do it directly on our own. Then you can do direct equity. Then second is mutual fund. So we don't have time, we don't have energy, we don't have other resources, so let's go give it to mutual fund. Then PMS, that is portfolio management service. There is a requirement of around 25 lakhs, somewhere 50 lakhs, somewhere 1 crore minimum requirement to be invested. Then you go to PMS. So I'm enumerating all of them because not sure which point of life we all are in and what kind of risk, what kind of journey we are going to undertake for reaching our financial milestone. The third is AIF, that is Alternate Investment Fund and private equity. There it is like kind of private equity. When say you have got some very large payment have been made to you, and you want to invest that in some kind of other industries or other unlisted companies, then it is private equity. Suppose you some of the entrepreneur brother that we have, they build a company, they sell it to a larger company, and then there is a kind of big milestone payment for them. Then they can look at this kind of option that they can launch their own AIA for private equity. Then lastly, we have ETF. So what is ETF? Is exchange traded fund. So if you don't understand, like most of us might not be understanding what is Sensex, what is Nifty. So we just go and buy Sensex or Nifty. We don't apply anything else. Like for example, say 10 years back, the Sensex was at 25,000. The Nifty, the Sensex is now 75,000. So suppose someone who was at 2014 didn't want to take any risk, didn't want to apply any kind of thought process, just wanted to buy Sensex. So if you'd have bought Sensex in 2014, his money would have tripled in last 10 years without doing anything. He has to be just there in ETF. So that is the beauty of ETF. You don't have to do anything. You just have to decide that what to buy, and then you go and do it and just leave it there. You are not supposed to buy any stock or anything else. Just buy the ETF. So these are different options for equity. Then how do we allocate? So equity, we have large caps. I will just define large caps are the big companies in the country, which are said which can be called the leader in their segment. So here the beauty is that there is no information asymmetry. We have so much of information all throughout. In the sense, through the financial newspaper, now internet is also very active in providing such kind of information. So here there is no information asymmetry. Any expert like any fund manager or any portfolio manager will not add value to your portfolio. So you can go and buy them, buy and hold. So the rule is buy leader across sectors, and they are very easier to research. Like anyone who wants to research Infosys or Reliance Industries or TCS or ICICI Bank, they will have all the options to research it. They can go and buy it, keep it with them, and keep it holding them. Next is large cap. We just discussed that the large cap is Go Index or ETF. There you can buy index or ETF. And of course, when you buy ETF, say you buy Nifty ETF, you are the owner of 50 large companies in the country. When you are buying Sensex, you are the owner of largest 30 companies in the country. So here what happens that you are automatically takes diversification. It is very cost efficient, and it is almost a no-brainer. So these are two ways in which you can be owner of the large companies. Say you can be owner of Bajaj Auto, you can be owner of Hero Motors, you can be owner of Maruti. These are the stocks which form the part of these ETFs. So the ETF construction is like that. They take leaders all across different sectors and segments. And if you buy them, you are indirectly owner of those companies. Whenever they do good, and collectively whenever they do good, you benefit out of that. So like the way I explained that the Sensex was 25,000, it is tripled in last 10 years. So you get that benefit. The value add where you are looking as it is mid and a small cap, which is it's considered to be little riskier. And why it is riskier? Because there is still high information asymmetry. Difficult to research, although the things have improved in last 20 years. That because of internet, you can research any company you want. You can find out details about any of them. There is a website available where you can find their investor presentation, you can find out information about them. So, but still there is an information symmetry. The professional fund manager, they keep meeting management. They are aware of the recent development. They are aware of anything new plans. They are aware of anything happening in the company which is not as good as people expect from outside. So these companies also have some kind of corporate governance issues, and you require a very constant monitoring. So whenever any of us decide to go for any mid and small cap, the advice would be that you go managed. You don't go on your own. The first two you can always do on your own. And so then we come to that, if you decide to have equity mutual fund, then how to decide about it? So the idea is that you do a performance-based ranking. You find out from the net or from the different allocator. They will give you the ranking of their past performance. And there is a SEBI categorization which categorize large cap, mid cap, flexi cap, multi cap. So based on this profile, we can select the right segment for us. Then track record of a fund manager. We can always track them, that how the fund managers have done in the past and where all they have worked. The caution here is don't play theme if you are in the long haul. So that means they are fads. Like if you look at now, the country is spending a lot of money on capital side, capex. There is a lot of capex happening, road, railways, defense. So it is in fad now. So don't go for it, because they are just a fad for the time being. They might not be around. So if some of you remember, in 2006 we had something like this, in which infra was doing very good. We have company like GMR, GVK, Lanco. Most of them, those companies are still not around. They have bankrupt or they have been sold off. So the themes keep appearing, because it is the human nature that we chase the themes, but try to avoid them if you are longer haul. If you think that you can time it, perfectly okay, but difficult to time. So then I would say prefer balanced fund over large cap. And every fund manager has his own style. So give some time to perform. And if you are very active on the fund management side in following fund managers, then follow their fund managers, and not fund will keep on changing. So and unless you understand the stocks, that means stocks they hold, don't get into the analyzing the portfolio of the fund manager. Just go with them with their track record. And the most important thing to find out about track record, that they haven't taken any extra risk in any point of time. The more volatility in the fund, the more riskier the portfolio is. So try to avoid them. So Alok, anything we want to add on the equity side here?
Yeah, Rahul, that was very insightful from equity side. I'm not sure, because the audience is very heterogeneous, so I am not very sure as to how what is the level of understanding of every participant. But I can probably assume safely that most of the people are very interested in stocks, so they know a little bit about stocks. But one thing that you constantly hear from people is about timing the market, and saying that it's should I buy right now, or should I wait? I mean, there are people who will say that it's going to go down. When it actually goes down, then you have people who say that it will go further down. So, and then when you think, and then when you and then, yeah.
Alok, you are on mute. Alok, you are on mute.
Sorry, you could hear what I said earlier?
Yeah, now we missed last I think few seconds.
So basically, what happens is that when you try to time the market, you ultimately end up not doing anything in the market, or probably do something which is not correct. You probably end up buying at the top. So how important is timing in this market if you want to achieve the returns that you want to achieve? Yeah.
So, look, you can share the data that we were discussing in the morning, that when we buy at the top and we buy at the bottom.
Yeah. So I think, yeah. So we discussed that, when we did an analysis of around last 40 years returns of Sensex or Nifty, if you call it. I think 40 years Nifty was there or not, I don't know. But Sensex 38 year returns, last 38 years. if you bought at the top for the year, for example, you have 38 years. Now, every year, if you buy at the top, meaning you messed up badly and you ended up buying at the top of the market every year, then you make around 14.2% return. So that is the return that you make if you buy every year at the top. Now, contrast this with somebody who buys exactly times the market perfectly, and which is of course not possible. But yeah, for brevity's sake, if somebody is able to buy the market at the bottom every year, he will end up making around 14.5 to 14.6%. So the difference is very, very small, which is around only 0.4%. So the moral of the story is that you it's very futile to time the market. It's never a good idea to probably time the market. That will you will probably end up not investing in the market, or taking very suboptimal returns, getting out of the market at very wrong times, and then probably later, having a feeling of, as we call in a new age, FOMO, which is feeling of missing out. So
Fear
that
of
kind of
missing.
yeah, fear of missing out. Sorry. Yeah. So I mean, to avoid that, basically, see, equity is, to my mind, is very risky if you do it for short term, but if it is not at all risky if you do it for long term. So equity is risky for short term, not very risky, or I would probably venture to say that it's almost one of the best asset classes if you do it for the long haul. So it's all about timing. It's all about the length of the time that you are in the market, rather than trying to time the market. So that's my take on it, Rahul.
Right, right. So just to conclude what Alok was telling, that equity problem is the volatility, not the return. So if you manage the volatility well, you will end up making a lot of wealth. So the history has given, the US has more than 100 years of history of equity market. We have around 40 years of equity market history. So the idea is that if you are looking for kind of wealth creation, just be there in equity without bothering about short-term volatility. And the how much percentage you want to invest is completely on the risk profile that you have. But and what way you approach is completely on you. You can buy all the leaders of all these segments. There are 10 sectors in the in our market. You buy top two leaders of all these sectors. You be with them, or keep buying them every month that you get your money, or do whatever you think is correct in your view. But at any stage of life, other than if you are in senior citizens have their own kind of risk profile. So don't avoid it just because of volatility. Give it a decent chance in your portfolio. That is the first step of wealth creation. Second, we move to the debt asset class, that is fixed income. Everybody of us would be invested in that in different forms. So it is not something very technical. It is just that there are many other options that we don't understand. So FD, I think everybody will have some kind of FD. Bonds are something like, say, Reliance Industries has a bond which gives you a return of 8% for next 10 years. That is very, very kind of FD, but it is issued by the corporates. And that gives generally higher return than bonds, but it is also taxable. Liquid mutual fund, credit debt mutual fund, duration debt mutual fund, all kind of mutual fund where money is deployed, and which gives you a very kind of steady return, the return which you know before, and you don't have to face any volatility in case you want to stay there for longer period of time. If you want to stay there for shorter period of time, of course, there will be volatility based on the interest rate movement. But if you stay there longer period of time, it will be around 7-8% of return. But remember, that is taxable. We missed one point in taxing in equity. Equity long-term capital gain tax is just 10% if you make more than 1 lakh profit in a financial year. So that gives you more incentive to be there. It is mostly in debt. It's mostly taxable. There are arbitrage fund, long short AIFs. AIFs is alternate investment funds. There are various structured products which are mainly for HNI. And finally, we have two government schemes, which is PPF and EPF, which we will discuss later. So here also we have a very kind of thumb rule again, 0 to 3 months, look for liquid funds. 3 to 12 months, look for arbitrage fund. 12 to 36 bond structured FD. So even if you have some surplus money, like you get money after selling something, some flat, some land, so don't leave it in your savings account. Don't leave in your current account. Look for some mutual fund for 3 months, 12 months. They will definitely give you, if not 2%, at least 0.5 to 1% higher than normal FD. And 36 months and above, there are debt mutual fund, which are of two types. One is corporate debt mutual fund, one who invest in GSEC. So just try to explore this before you put your money in FD. Of course, based on our risk profile, everybody should have some exposure to FD, but don't put all your money there. And try to explore the other option in debt. There are many options other than FD in fixed income. So how to evaluate debt mutual fund? So we have accrual and we have duration. Now the terms are little technical, but I will try to explain it in different way. So accrual is, that means you buy a fund which invests in corporate bonds. So every year the bonds give the interest, it comes to you. And duration is the call on the interest rate. So if interest rate goes up, so then your fund value will come down. So if you look at the larger picture, so if some of who are older, who are in before 2000 would remember that interest rate was 11-12%. Before that it was 16%. Now we are at 7-8%. So for any developed economy, interest rate will keep coming down, and if interest rate keep coming down, your fund value will keep on increasing. So the first option, the accrual option, is completely because of the credit profile. That means you buy good rated bond. And second is completely a call on the interest rate. So based on your interest, based on your profile, you can take exposure to any of them. The tip of the day is the park money in ultra short term risk adjusted return is by far the best compared to others. And try to explore to place all your surplus money in some kind of ultra short term liquid fund. Now there is always a question that how to construct a portfolio. So it is always seen that the stock selection or the security selection is always emphasized, and constructing a portfolio is not important in most of the literature. But I think the constructing a portfolio is the most technical and most difficult job that a wealth manager or a person who is creating his wealth plan will have. So it is a very tough task, and it is a very technical task. Of course, there are so many factors to take into account. So whatever happens, like most of us, some of us, we have seen that they end up buying a lot of assets. But then when they grow old and when they say reach 60 years or when they retire, they realize that there is no cash flow to support their life. So don't make a mistake to put all your money in asset creation. There is an optimal balance. So try to find out if there are asset classes which will give you cash flow, there are asset classes which is asset creation. So asset creation, like gold is an asset, not very liquid. It will not give you cash flow. Land is an asset. Real estate is an asset. So these are the asset, but they are not liquid and they are not income generating asset. So what you have to find, that you have to find an optimal balance between the cash flow and asset creation. And asset allocation is a function of investment horizon, investment objective, your risk aptitude, and liquidity of the instrument. Remember, liquidity is very important. If you have some land parcel and people say that in this area the land is selling at say 10 lakh per acre, but nobody will have that kind of money that will buy the land of whole area. This is just an indicator. When you go to actually sell in the market, the liquidity of the instrument will be very important. So try to diversify, try to put money in different assets, and try to put assets in the liquid, both liquid and of course the illiquid assets are one of the better wealth creation. The land has been a good wealth creator, the gold has been a good wealth creator, but those are illiquid assets. So you have to keep accumulating them, but in a different proportion. So categorizing objectives is very important. Some are your basic needs, some are your basic requirements, some are your needs, and some are your want, that is your consumption. So you have to categorize your objectives in 3 categories, and then you have to plan accordingly. So some of the things that I want to talk, they are very basic stuff, but we almost forget them on our daily basis. There are some very tax-free government schemes. It's kind of social security schemes for us. which gives steady, effective, silent compounder with a forced discipline. By forced discipline, I mean that they are very liquid. So, like take example of PPF, you are not, you can't take money out of it for in 15 years. So, like EPF, it's very difficult to get money. There are some conditions to be fulfilled before you get the money back. Only if you turn 60 or if you retire, you get money. NPS is the almost similar kind of thing. These are all give you 8%, between 7.5 to 8% risk-free return. Utilize to maximum. Use all your PAN numbers, all your family members to get exposure to this thing. Use Sukanya Samriddhi scheme for if you have a daughter who is less than 18 years now. If you have a senior citizen in your family, use his name to have exposure. And remember, if you want to do your FD and if you are parents, the tax, there is some tax arbitrage there. So use your parents account for FD, and tax authority allows this, but they don't allow it for your spouse, even if it is she or he is not earning, they don't allow it. So the senior citizen, they will give you higher return than what you get generally, and there will no tax. There is very minimal tax because they would mostly fall on 10 to 20% bracket. So these are the very simple stuff. First, do them, then only move to your different kind of complex structure like equity or debt. So to summarize, use all your PAN numbers for all these schemes, government schemes. These are our tax-free return for very longer period of time, very liquid. You can't do anything. And missing any of these eligible scheme is almost a criminal on part of wealth management. We come to a very complex kind of investment with real estate, which I think other than house, if you buy anything for investment, it's called real estate. You can buy physical real estate, you can buy InvIT, you can buy pre-lease commercial properties based on the ticket size. You can buy some of the real estate. People have started offering different products for real estate. So there are there are issues in real estate. It is very high ticket size, very high transaction cost, the high stamp duty, brokerage. If you buy, sell them, you will lose out 3-4% on this 3-4% in just a transaction, which is not under control. I'm not talking about the government duties, but just the transaction cost. Low liquidity results in hefty haircut in case of immediate liquidity requirement. You have to sell in distress. But they are long-term wealth creator in a country like India where there is a short supply of real estate. So if here also, I think we are emphasizing again and again that this is for long haul. This is also for not haul. And if you have physical real estate, it requires management and maintenance. We have a portfolio building and diversification. So we have an approach in which we are strategic. So we mentioned different factors in previous slide. Tactical, what is your current investment outlook? Where do you want to invest now? So then there is another aspect that lump sum. And or do you want to do SIP? Lump sum is that you put all your money in one go. SIP, if you do a cost averaging, it's kind of cost averaging it's a kind of diversifying over a period of time. So we require diversification. Alok, you can highlight this diversification point that we're discussing. I think Alok, yeah, Alok.
Yeah. So I think so. Two things. I think what you said. One is diversification. So I will just probably stop and try to reflect on diversification. And one is SIP, which is basically you have a discipline which it's a kind of forced discipline that you talked about in a lot of illiquid instruments. SIP, when you invest, is not illiquid. You can take it out anytime, but it is also a sort of discipline that you inculcate and try to increase wealth. In fact, SIP. So compounding, Warren Buffett once said that compounding is the eighth wonder of the world. And really, if you actually look at the numbers, then it's amazing how there's a difference between when you start at 30 or when you start at 20. The returns can be the difference between the returns can be as high as 2 to 3 times. So let's say you invest 10 lakh and you get to let's say a 40 lakh portfolio. If you start at 30, 35, but when you start with at 20, which is 10 years earlier, then you can probably end up at a very, very high level, meaning a 40 can be as high as 80. So So that is deployment, and then diversification. Diversification is something that is it is basically we don't put all your eggs in one basket. I mean that's the adage that goes, and it's true for investments as well, because it's always better to put money in different asset classes. Many a times what happens is one asset class moves uh, opposite to the other asset class. So for example, investment in gold or silver, and it's common knowledge, we all know that when the equity markets fall, they most of the times go up. So diversification of a portfolio, ends up saving you a lot of stress. It builds a portfolio which is slightly future proof, meaning it is you will probably not end up having a disaster in your portfolio if you diversify across categories. So that's very important. So power of compounding and diversification across asset classes. I mean that is something that Rahul said, and that is what I can sum up in this discussion.
Right. So then we move to the last part, which is the insurance and risk management. So why we are talking about insurance in the risk and insurance in the wealth creation forum. So like we deal with the two risks, going too early or living too long. Both are risks. So insurance helps in both. That if we are not around too early, and if we live too long, that is also a kind of risk in which we don't have a social security scheme like pension that the earlier generation had. So it's very important to plan it. Very important to plan at least three things. The first is going too early, living too long, but living too long healthily. So the going too early, there is a term insurance. I will not emphasize. Everybody should be aware about the term insurance. It is like if we are not around, our family will get a lot of money. So of course the physical presence will not be compensated, but at least financially they are safe. And it is almost like I can tell you that it is an insult to family if you don't have term insurance, that we don't know the uncertainty. So whatever the capacity is, everybody should have a term insurance. So from whichever company they are willing to take, from whichever form they are willing to take, please take a term insurance. We don't know what will happen. All your plan go haywire if you don't have a term insurance. Even if you have a home loan, and if you're living in that home without term insurance, the home doesn't mean anything. So it is like planning when we are not around. Second is health insurance, which is we are living too long, then we have health and income. And for health, the type of the cost that we incur, we should have health income. Of course, I will not emphasize further. You can find out from net the health insurance. It's very much required given the type of cost that we incur now. Uh, I will emphasize this slide, managing living too long happily. The idea is that there are some products which is not very popular, but that helps in pension planning. So then that means one that leave your EPF in PPF, NPS completely for pension. Don't even touch them. Don't even think about them before your retirement. So they because of the compounding that Alok mentioned, they become a very very huge figure when you retire, because the interest accrual is tax free 8%, which is like doubling every 8 9 year, plus the fresh contribution also goes into them. So leave them completely. Then there is something called annuity, which you can buy from any of the insurance company, which pays you monthly pension. So if you get some lump sum money from somewhere, you can buy a monthly pension, which can be a different form, which can be for a time period, which can be your family pension, which can be uh, any form which you desire. Then this is not very popular, that we can go today and buy something which will give you 8% return for next 30 years. So Government of India, it is called risk-free investment. So Government of India has 30-year, they have even 40-year bond, which any retail investor can also invest. And you can go and buy them. Even if you are 40, next 30 years is safe. If you invest a large amount of money there, then you get a steady flow of income and assured income for next 30 40 years. This is not very popular among retail investors because it is taxable and nobody talks about it. It's Government of India risk-free rate. So, but you can explore this. You should explore this. Anyone who is nearing 40, 50, they can buy now because as we mentioned that interest rate was 15, 60% 2, 3 decades ago. It was 10, 11% 1 decade ago. Now we are reaching at 7, 8%. So this interest rate will definitely go down. So the idea is to buy something which will give us a steady state of money, a steady state of cash flow for next 10, 20, 30, 40 years. The instruments are available, not very popular, but can be easily accessible, can be easily bought over. Second, the third, last instrument is non-par. This is not very popular instrument. It gives you 7% tax-free IRR, and it is called guaranteed product. And it is also kind of if you give money for next 10 years, then after 10 years they will start giving you back. It's almost like if you say pay 25,000 now for next 10 years, 20,000 per month, then you can get 50,000 after that per month. So that's a very, very attractive kind of return as of now. And the beauty is that 7% tax free you can capture for next 20 years, and that is tax free. The only call you have to take that which company you want to buy it. So that is also very useful for pension. So these are some of the products other than wealth creation. We should also these also take care of the pension that we can assure for ourselves. So we will summarize with key points. So it is good investment. Good investing is not necessarily about the best decisions. It is about consistently not screwing up. These are very, very basic stuff. You have to just diversify. You have to just be there. You have to just don't make large mistakes, and there should not be any disaster in the portfolio. So these are the key points that we should leave with you. So the first is diversification. As Alok summarized, it is don't put all your eggs in one basket. The thumb rule is higher returns come with higher risk, but there is a chance that product with abnormally high returns capability can also wipe out your capital. Don't get into the anecdotes that people tell you that this money got doubled or anything. So the risk-free rate in the market today is 7%. That is Government of India risk rate. Anything between 7 to 12% is perfectly okay. If anyone talks about 15%, that is little risky. If anything talks about more than that, be very aware. Be very, very aware that there must be something. So whenever any person offers you chance to earn a lot of money without risk, don't even listen to rest of this sentence. Follow that, and you will save a lot of money. So the next is discipline and patience is of utmost importance in investing. Wealth is what you don't see. So this is only possible if you have very just little amount of discipline and huge amount of patience. Systematic investment, that is diversification across geography, diversification across time, diversification across asset class, is the best method of investing. Consider all the aspects before investing, especially the transaction cost, and always plan for future. Important thing is to be wealthy, but more important thing is to stay wealthy. And I will leave with a line that the most important part of every plan is planning on your plan, not going according to your plan. So the idea is that we plan everything, but there should always be a backup plan, and you should have always something in which the things don't work out. Then what we do, the final part of this session will be the few minutes guide on the careers in finance from Alok. So Alok, over to you.
Thank you, Rahul. So I think it was very insightful, the whole presentation, and key takeaways from this is probably one that we talked about is basically the power of compounding. And you have to start early. You save, you don't save what is left after all the expense, but you probably have a plan for saving. You have a amount in mind that I'll save this much. For someone who starts early in life, when they get a job, they should have a kind of target that I'll save, let's say 25,000, 30,000 a month, and then whatever is left you spend. So it's a different mindset that we're talking about. One is a spending mindset and one is a kind of saving mindset. So you start early, you benefit from the power of compounding, and then be patient. uh, If you want to be in equities, you just do SIP for very, very simple reason that it's very, time efficient. You don't spend a lot of time. You don't rack up your brains as to when to invest, what to invest. इसको खरीदें या बेचें या मार्केट में मुझे टिप आया है कोई SMS में मुझे बोला है please buy this stock and all that. So just escape all that. You focus on your career, which may be in different areas, and just let the power of compounding work on your portfolio and see miracles happen. So that's the summary that we have. Insurance, again, Rahul said, it's important, and it's important because we don't know what can happen tomorrow. So that's why it's important, and it also gives you the peace of mind. It guarantees a certain basic, lifestyle for your family in case of anything, anything happens. So that's, I think, those are the key takeaways for me. Yeah, thank you, Rahul.
So Alok, just few points on the career in finance, because we have some younger brothers also who might be looking something on that, because you were in corporate finance, you had a finance for such a large conglomerate. So just few options there that they can have.
Yeah, so I'll, so we should we take some questions now, or we will take?
Yeah, so we have some questions in the chat box. So
Okay.
Vinayda asked that, can you specify any particular guaranteed product, the last item? So Vinayda, there are some products you have to just tell that you want non-par guaranteed product. The I will not name any company because that will not be fair at this forum. So, but offline I can suggest some companies, but all the companies, they offer very similar kind of rate. They all offer 7% IRR. And so you have to just tell that you want a non-par guaranteed product. Then they will understand that he's talking to some knowledgeable person, and then he will offer you right product. Then Alok, there is a question is that please suggest some of the best mutual fund in the market. So Rupjyoti, this is like we can't be telling the names here. We will only tell the names which have a good research process, which don't go by the facts available in the market. So all the big names that you can think of, those are there. Just it's not about the mutual fund, it's about the fund that you select. So be there mostly in large cap. The exposure to the mid cap, because you are young, I can see you passed in 2003. So the exposure in mid cap can be there, but don't go overboard on the market movement recently. So be very diversify. Go to some of the large caps or flexi caps, and then add some of the mid caps from the whatever name you find useful from the mutual fund side. Then we have any company providing term insurance, Dr. Skesina. I shall get back Dada separately. That this. So these are some of the questions, Alok, that we have. Now we are open to question. Anyone wants to ask any question or any clarity on the products that we mentioned, then we are here to answer.
I would request.
Yes.
Yeah, I request those who want specific suggestions, they can personally contact Rahul Da or Alok Da in their personal chats or by calling them. So we have their numbers. So they can directly call them and chat to them or get the suggestions.
So
Rahul Da,
Rahul is tied by his his role in a company where he's a fund manager, but I am not. So I can of course suggest you. See, the question was that which mutual funds are the best mutual funds. See, I'll give you the process if you are little interested in how to find out which one is the best. So when we were in treasury, we were evaluating in which mutual funds to buy. Then we used to see the last 3 years investment returns. So and there is something called a benchmark. So every mutual fund has got a specific mandate. By mandate, I mean that let's say it's a large cap fund. So it has got a mandate to beat Nifty, because Nifty is a large cap, sort of Nifty is a group of 50 companies which are large cap. So the large cap fund has the mandate to beat Nifty. So you have to see how the company outperformed that Nifty in the last 2-3 years. You have different slices of time period: 6 months, 12 months, 24 months, 36 months. Then you also see then when the market fell, for example, let's say in some year the market went negative. So at that point of time, how did that mutual fund fare? So let's say if the market went down by 7%, 8%, and the fund went down by 2% only. or alternately it went down by 10%. So there's a difference, right? So extremely aggressive mutual fund manager will probably fall 10%. A slightly lesser aggressive mutual fund manager would fall 2%. So then you have to then think of your risk profile and then decide which one to invest in. Also, the return volatility across years is important. But one more thing that you have to remember is that a return is a function of which fund manager was there at that point of time. So if, let's say, if you do a little more research, you will figure out that some star fund manager was responsible for example, I'll give you an example of HDFC mutual fund. There was a star fund manager who was responsible for outperformance for a lot of years, but he has moved on to some different mutual fund. So fund manager, if you know some fund manager, or if you see a mutual fund outperforming, then you have to figure out if that fund manager still exists in that company, and you have to see what the fund has delivered outperformance with respect to the benchmark in the years in which the market gave positive returns, and how much it fell when the market gave negative returns. That will give you the kind of a bunch of mutual funds where you would like to invest. And giving Kotak, ICICI, SDFC, all these funds, SBI, Axis, it's better to be diversified across fund managers and fund and mutual fund, so that if let's say somebody is facing a tough time, the other funds, every fund manager cannot go wrong at the same time, right? So that's if that is something that helps you in planning, I think you should diversify across mutual funds as well.
Look, we have some more questions there. So the question is, what is the criteria of buying bonds? Is it tax free and NRA can invest in or not?
Yeah, so I think you are the better person to answer it. Tax free, tax status, what is it when bonds? I just
So there are both tax free and taxable bonds. So taxable bonds gives you around 7.5-8%. Say I will take example of Alok company only. So Reliance Industries, when they come up for any capital raise, then they can give you something like 7.5 and 8%. There are other bonds also which gives you 8.5, 9%. But remember that you have to just do a simple check. If they are AAA rated, buy it. If they are not AAA rated, even if they are AA plus, you are okay. But if it is below that, avoid it. You can't be mastered in managing their rating. So someone else has done their rating, AAA, AA plus, do that. Otherwise, for us, give it to expert, or for us, if you're doing on a personal basis, avoid it. So then there is another question that what should be allocation of gold in financial portfolio in India? In long-term, gold and equity have moved almost similarly over the longer period of time. Satyam's question. Satyam, this is a very interesting question. The gold. The problem with gold is that the gold returns are very lumpy. So for say 10 years, gold will not give you return. If you have that much patience, then you can invest in gold. But we will still advise that you should not go beyond 20% in gold because of its lumpiness nature. There was a period of 20 years in which gold was just giving single digit return, 5-6%. We are all guided by the recent run, but don't go beyond 20%. And that too you can do by if you are buying actual gold, it is perfectly okay. You can buy actual gold. There is another way to get exposure. You can buy Government of India gold bond, which gives you 2 to 3% assured return plus any upside in gold prices. So Satyam, that can solve this thing, especially okay. Next, to what?
Just to correct Rahul, that Satyam's observation that gold and equity have moved almost similarly over long run. Just to correct that, if you see last 20 years or 30 years data, then equity portfolio would have given you a compounded return of around 13 to 14%, and gold would have given you around 7% to 8%. So that's a difference. And if you see the power of compounding, then gold is definitely not going to give you the return that equities is going to give. And contrary to the perception, and probably what normally you tend to follow the market and tend to get advice from others in the family as well. But gold, if you do some analysis, you will figure out that equities have outperformed gold big time. Yeah.
So then Ashish Da is asking that what extent to rely on the fund manager of my bank. So bank will have a mutual fund, Ashish Da. They will not have a direct fund manager. The bank will come and sell you different mutual fund depending on the commission that they get. but you should do your own research for any kind of this thing, because bank is just an intermediary. They will not have direct investment, so they will sell some mutual funds product. And yeah, yes, Ashish.
Yeah. So what is the alternative? Because what happens for people who are settled in life, we are not looking for any extraordinary return. We want a normal, healthy return on whatever we have. Okay, on the investment, uh, and for people who are not usually actively looking for, you are people who are 24/7 onto what is happening in the market. Okay, uh, we are kind of people who are not that. So we have to rely on A, B, or C on
So,
our
Ashish,
portfolio.
yeah, so Ashish, I will
Yeah.
just say you that SEBI had categorized all the stocks into different categories. So large cap, mid cap, and small cap. You stick with any large cap, the fund manager is not allowed to go beyond top 100. So even if he wants to take risk or he want to commit mistake, he's not allowed by SEBI. So to be on better side, buy any large cap from a large mutual fund house. The fund manager's hands are very tight in that.
Okay.
He will not be adventurous.
Okay.
So every fund has got a mandate, and that is very clearly written that they can do X, Y, Z, and they stick to that, because that's what the person who was giving money is probably telling him to do that. So he's bound by that, and he's not going to go beyond that.
See, what we have found earlier was that banks were very keen on selling a particular instrument, but after selling that instrument, it's kind of they wash their hands off.
Right.
And they have moved on to some other instrument of some other company. So I have faced this issue. It's
Right.
not that I have lost money on that, but I didn't feel nice about it.
Right, sir. So Ashish, don't get into any structured product. They're very difficult to comprehend. Stay with very simple products. People have made lot of wealth with very simple product. The structured product looks very exotic in the shorter term, and they play on the volatility in the market. But in the longer term, they don't give that much return. So stay with very simple products, very simple philosophy. I think that will do. Don't fall for any such kind of gimmick.
So whom do I go through in that case? If it is not the bank or the bank's fund manager,
banks are perfectly okay. You have to choose the right product.
Okay.
So banks will give you some kind of product. Those are mostly called structured products or the sector themes. The themes which are very popular now, they will come and tell you that this is doing very good. Of course, the infra is doing very good. So they will come and in India में तो invest होने वाला है, road बनने वाले हैं, so invest in that. But that will be there for 2 years. Those companies might not be around after 5 years. I mentioned that in 2006, there were a company called Lanco Infra. There were a company called GMR, GBK. There were a company called Punch Lloyd. So those companies are not around. And we all got those carried away by those short-term successes. So don't get into any fad. Just be there in the large caps, and very common, very simple philosophy. So then there is another question, that how do you look at the present market, especially when everything is at all-time high, be it gold, share market, or real estate? So Amit, as Alok mentioned, that it's very difficult to time the market. So be diversified. If you have some money, put it all across the asset classes. Do time diversification, do asset diversification, do geographic diversification. There is no other medicine that we have that we can predict a market, that how it will happen in next 1 month or 1 year. But we are very sure about next 3 years that all these asset class that you have named should do good. That is the philosophy that we follow. But definitely all the markets are overheated. So if you want that, you can better time it, put it some liquid fund, put it to some FD, and then when there is a fall in the market, every year market falls almost once or twice 10%. There are very rare instances, but those are mostly buying opportunity, especially in market like India. So just to draw an example, Japan equity market didn't give return for 30 years. Now they have recovered. So don't fall for recent moves. Don't fall for the anything exotic that people tell you. The basic philosophy is to diversify all across asset classes, and nothing else will do. So
If you can see my screen, I mean that to emphasize the same point that I said earlier, that if you bought every year, last from 1980 to 2018, you bought at the low of the market versus you bought at the high of the market. Every year you were wrong, and but you still invested at the high of the market. This is what is the difference: 14.8% versus a 14.2%, which is around 0.6% difference. If you are completely wrong in your timing, so you will probably somewhere you will end up somewhere in between, right? So maybe 0.2, 0.3% is what you lose. So it's not about, if I were to take a small quiz now and ask you that who is going to generate the highest returns in the 20 years or 25 years, 30 years of his investing life, A, maybe a person who is very good in stock picking, B, someone who is very good at algo trading, algorithmic trading, or C, a person who is very patient. The answer would be C. I mean, that is that easy, but easier said than done. Patience is not something which comes very naturally to us, especially today when you have mobile phones where you can buy and sell shares on your phones. It's very difficult to not click a button for next 30 years or 20 years, right? So easier said than done, but rest assured that the person who makes most in the market is the most patient one. The money will go to the most patient one in the market.
So just to because we are just about to finish, so investment is 50% science, 50% art. So the science is that finding the right product, and art is like being there. So Abhishek, I think we have crossed the time actually, so it's almost 7, more than 7.
That's fine. That's fine. Yeah. One question I think you have missed. Satyam has a question regarding the investing in real estate. Satyam, you can go ahead and ask the question.
Yes, Satyam.
Yes, so actually two questions I have. First of all, like I see a lot of people of my age, so they would go and buy a residential flat, maybe mostly because there is a tax exemption that you can use on the EMI payment. So is it advisable for a young person early into job to buy a flat for rental purposes and then cover the EMI through that? And the second, because we all are looking for good advices, it would be great if you could discuss about SEBI registered investment advisors for the benefit of everybody, and in case you could suggest someone whom we can get in touch.
So Satyam, we can't suggest any advisor that we will handle there. I will just suggest what I was talking to Asista, that advisor will give you all kind of product, but be very the product that you understand very clearly and in very simple philosophy, stuck with that. And the advisors, I'm not able to help you with the name of the any advisor that we have.
Like
So
SEBI
advisor, I think,
registered
Satyam,
yes.
Satyam, advisor would probably, the simplest advice would be to do SIP, do it on a consistent basis, and for equities. Now for if anybody is giving you any other advice, probably he's trying to maximize his own returns of commission, right? So don't fall for advisors. Do some basic discipline in your investing in equities or debt. For real estate, I am not sure if there is any person who is qualified enough to probably say that this is the best investment, because real estate is very different. So it's a area dependent kind of investment. So one investment in real estate can work, the other one may not work. And land is always the best investment if you are lucky and you have done at least basic due diligence of the area and the future plans of that area. Then you will probably outperform every asset class. Land is such an asset class, but there are 2-3 risks associated with it. It's very illiquid. It runs the risk of a lot of maintainability, as we call it. I mean, it's, you have to go there, be there. You can't just leave your land just like that. There's a risk of somebody trying to get hold of your land. There are a lot of issues with land. But if you can get a land which is in a very upcoming locality, I can bet that it will outperform every asset class. But it's not so simple. It's not very easy to find any advisor for a real estate. I have not seen any. I have not encountered any real estate advisor. I've seen a lot of advisors on equity, mutual funds, debt, but not on real estate. Rahul, have you seen anybody advising on real estate?
So there are advisor on the commercial real estate side, and of course, Satyam is looking for something on the residential side. Difficult to get, but Satyam, anytime buying a house for personal use is definitely a yes. And for anything other than that, you have to do your own research. So because that is kind of, we can't model it that how real estate would do. So
So Satyam, one advice that I will give you is that I have seen that, especially in a market which is already identified. For example, some markets are already identified, some areas are already identified. If you do investments in that, in a commercial, in a residential space, which you are not going to use, you're just going to invest. Most probably you will not get very decent, very good returns. It's always, few years will outperform. Last 2 years has been very good. 2000, I think, uh, 11 12 was very good. I think 11 14 was good. But other than that, it's very difficult to get a return in a residential market, in a market which is already there on everybody's radar, because it will price out everything, and then you will end up having a very suboptimal return in a residential space. So, I mean, residential space returns, I have seen very few people making money in that. If it is for your own use, by all means you go for it. But if it is for investment, you have to think, because that is competing with every other asset class that you have a choice. You have a choice of equities, you have choice of every other asset class. So it is competing with all the asset classes. In real estate, you also have some prices to pay every year, because you have to maintain that flat. You have repairs, you have maintenance, you have got society charges, all that you have to give. After that deduction, and then if you have taken a loan, and mostly you will be taking a loan, then there's an interest cost associated with it. So you have a 8 to 9%. The hurdle is 9%. You have to beat that 8 to 9%, and then only you start making money in real estate. And that's why residential real estate is very difficult to make money in it, if that area is already in everybody's radar. If it is not, if it is something which is nobody knows about it, and you did it, and then that area became kind of very hit, or something came up in the vicinity, then you will probably make a lot of money. But very difficult to plan for it.
yeah.
Okay,
Another
thank you.
question regarding this real estate. There is always a debate going on whether to rent a house or whether to purchase a house. So how it varies with cities, like if you compare Delhi, Mumbai to a tier 2 or a tier 3 city, what would be the suggestion to whether to purchase a house or to rent a house?
So actually, we do kind of rental yield. So rental yield is like 3.5 to 4% now, because the rental yields have gone up in all the major cities. So we kind of do a cutoff that if rental yield is more than 3%, then definitely you should not be on the rental side, buy it, because it's not good to give such kind of rental yield. So in some of the areas in Mumbai, the rental yield have gone to 4%. In Bangalore also, some of the rental yield have gone to 4%. So do a basic calculation. If rental yield has gone beyond 3.5%, better to buy it. If it is lower than that, better to be in rent. So this is a very kind of thumbs rule. But of course, it is a very personal choice, and kind of resources that one person has, he will take it call. But mathematically, this is the rule that we follow.
So rental yield, I mean, for everybody's benefit, rental yield is basically the total rental you pay for the year divided by the price of the house. That's the rental yield we are talking about. So that, if it is, so Rahul, if I understood you correctly, 3.5% to 4% is your barrier. If it goes beyond that, then you go for buying. If it is less than that, you probably maybe 3%, 3.5%, you're neutral. If it is 2.5%, then there's not
Okay.
much sense.
Yeah, better to stay at rent for that. It is a mathematically, but house is completely different prospect and completely different value. So of course, mathematics is just an input.
Thank you. I think one question that would help others also. Rupjyoti has asked, please suggest good websites for research regarding the market. And so, can you suggest any
So now
websites?
actually the website was very good earlier, very useful. Now there have been YouTube videos which are available in the market, available on the website. So other than value research and the other similar website, I think
Funds online, right? And that's
which one?
mutual mutual funds online or something. There's a mutual fund website.
Online value research, these kind of websites are there. But I think doing the YouTubes are very useful. Of course, you should not fall for the advice that they give on the buying the stock, but those are very useful YouTube videos. And plus, there are investment books. So there are investment books available which has been written by the veterans. So of course, it makes sense to go through them. Very simple English, very simple kind of philosophy. And Intelligent Investor by Benjamin Graham. People keep writing. Advice to start reading any kind of business newspaper like Business Standard or Mint. In 1 month you will get to know what we all talk about. So all the experts you can get all the knowledge that the experts talk about in 1 month. So there is no information asymmetry as of now. Everything is there. Everything is there on there in all the newspapers.
The Money Control is also a good
Money
place
Control is also
where
good.
we can probably do some research. Yeah.
So Abhishek, it has been pleasure for us, and it is an honor to us to address this. So Sarad, I can see Sarada, I can see Balada, Vinayda, Asista. So lot of seniors which we looked to in our school. Sarada from Singapore. So nice to see you there.
Yeah. No. I'm so sorry. I mean, I couldn't join earlier, but I was listening intently. Uh, in the investment profile, I mean, how do you guys look at the health insurance part? I mean, I know, I mean, it's a totally very vast subject on its own, but sometimes in our investment portfolio, one thing which we really neglect, and then we look at like reaping benefits. I mean, something I invest and I expect to come back, but that health wala portfolio sometimes we really ignore, and I believe that should come in somewhere in our investment plan.
Right, sir. Right, Shraddha. So we covered that in earlier part of the presentation. So we
Oh.
talked about living happily and living long happily and living with pension happily. If you
Yes.
stay for longer,
Yes.
then also you live happily. So that health insurance was one part of that, and it is very important nowadays with the cost escalating. So I will just give you one tip there. So there is a base policy for health insurance. There is a top-up policy. So even if you have a base policy of say 2-3 lakhs, get a top-up policy of more than 10 lakhs, 5 lakhs, because top-up policy comes into picture only if you exhaust your base policy, and top-up policy comes very cheap. So get a base policy which will cover the normal thing, and in case of any complexity in life, I think we should have a top-up policy for health insurance. But we talked about 3 things, Saradha. One is term insurance. Not having a term insurance is insult to the family. Not having a health insurance is insult to ourselves. And not having a pension plan is insult to the senior when we become senior citizen that is there.
Correct.
All these 3 are very important in wealth creation.
No, thanks.
Again, one question regarding the health insurance. Like many of us are employed in certain companies, and companies have group insurance policies. So in addition to those group insurance policies, is it wise to purchase, or should we prefer personal insurance, individual insurance?
So Abhishek, that forms your base policy. So I will explain you what is top up. So base policy top up is that suppose you have a base policy provided by your company 3 lakhs, and then you take a top up. So when you exhaust this base policy and you show a document that you have exhausted, then the 10 lakhs is enforced, and the 10 lakhs comes at 1/4 of the price. So leave it. That forms your base policy. Get a top up policy on health insurance side. So there is a
I'm
difference.
asking,
The first Google search will give you what is top up policy.
top up company also gives the top up in the group
Yeah.
insurance, but
So
I'm asking about the individual insurance. Like personally, I take the individual because there are certain benefits in the group insurance policy which are not in the individual insurance.
So group policy is definitely okay, and then take a top up policy for the family.
Okay, thank you, Rahul.
So I think see, if you are planning to leave a company and you have a policy, then probably it's better to probably start looking for a policy for yourself early only, because if you think that you will be on your own, but if you think that you will be probably working with a company which is good and you are going to be there, or probably even change. If you change, then you change to a good company. Then till retirement, at least it's taken care of. Now, I think what your question may be that what happens after retirement, right? I mean, many companies have now, for example, Reliance. I'll tell you, for Reliance, they have started what government does. So you can talk to your employer and say that, can we have the people who have left the company or retired from the company also participate in this insurance? So in our company, Reliance, what we have done is we have also negotiated with the insurance guy and have a policy for the people who have retired from Reliance. Of course, there's a condition that you should have put at least 10 years in Reliance, last 10 years in your Reliance. So that's how some corporates are doing it. If you are in a position to influence your HR, you should certainly talk about it. But I agree to your point. If you have a very good policy with your company, and then when you leave the company or you retire from the company, then what? Then the health insurance becomes very, very expensive if you start that late. But yeah, I mean, Rahul, you have any answers for that? I mean, how do you manage that? How do you make that transition from company insurance to your insurance if you're going to leave working at 58 years or 60 years maybe?
No,
How do
so
you
better to buy health insurance, some health insurance now. If the premium is very high, but start with 2-3 lakhs, and then of course the point I explained, the top up policy, keep a 2-3 lakhs policy as of now, so that it doesn't increase with age disproportionately. And then when you grow old, then you buy top up policy.
Right. Thank you. Thank you.
So
Actually,
I also replied to a few messages I've given some screenshots. So I think I'll try to answer a few more. Let me see. Yeah.
In Vidyapit, for Vidyapit Praktani also, there were a drive going on to get on with the group policy, but I don't know, most of the people, many people were interested also, but I think the count didn't go that high, so that it would be beneficial for taking the premiums.
So it's
So
about the
we should
scale.
try for that.
Obviously, it's about the scale. If you get more people, then premium will come down. And plus, for insurance company, the risk will be diversified.
Right. Younger the population, the
better terms you will get.
Better deal we will get. Right. So let us try. We will again talk to our Praktani team and try to get that insurance, group insurance. Thank you so much, Alok da and Rahul da. It was like really beneficial for those who are especially not in the financial sector and who don't know the real terms, like not technically educated in the financial terms. So it was quite useful for all of us. I think the attendance was quite impressive, like more than 20. It stayed for more than 20. So I was not expecting so many people coming. And I think usually it remains around 10 to 15 or 20, less than 20 itself. And many more people usually watch it on YouTube, and we'll be sharing this on the YouTube and other social media platforms. So I think I should thank both Rahul da and Alok da and our audience for such an insightful session.
Thank you so much. It's a pleasure to see Balada there, the chartered accountant alumni of ours.
नहीं बहुत अच्छा था. It was really nice.
Balada, आपके लिए क्या, आप तो chartered accountant है, मतलब the veteran.
नहीं मैं ये कर रहा हूँ. I was saying कि I gave my comment just after you talked that it was very balanced and comprehensive, and you followed all the rules of I would say a fund manager, conservative, not talking out of the way, being very, I would say, ethical in your talk. So very good, excellent.
Thank you, Balada.
Thank you.
So I think the formal session ends now, and I will stop the recording. And maybe for the informal session, if you want to continue, you can continue. So I will stop the recording now.
Okay. So Balada, अभी आप बैंगलोर में हैं?
हाँ बैंगलोर में ही हैं.